Today, we're breaking down one of the most important trading psychology books ever written, Trading in the Zone by Mark Douglas. This isn't just another technical analysis book. This is about why 95% of traders fail despite having solid strategies. It's about the psychological warfare happening inside your own head every time you click that buy button. About the author. Mark Douglas started trading in 1978, lost almost everything by 1981, and spent the next decade figuring out what separates consistently profitable traders from everyone else. What he discovered had nothing to do with finding better setups. It was all about mindset. We're covering all 11 chapters. This is the essential framework every serious trader needs to understand. Let's get into it. Chapter 1, The Road to Success. Douglas explains that trading has gone through three major eras. First era, fundamental analysis. Back in the 1970s, this was the only legitimate approach. Traders attempted to predict prices using economic data, earnings reports, and supply and demand factors. But there was a problem. Markets are driven by human emotions, not purely mathematical models. Fundamental analysis creates a gap between what should happen and what actually happens. You might eventually be correct, but volatility can wipe you out before you ever get there. Second era, technical analysis. Traders began to realize that human behavior creates repeating patterns. If you can identify these patterns on charts, you can anticipate probable price movements. Technical analysis works, which is precisely why it created a new problem. Third era, mental analysis, or what is now called sentiment analysis. Here's the paradox. If technical analysis works and opportunities are limitless, why do most technical traders still fail? The reason is simple. The problem is not in the analysis. It is in the trader's psychology. Douglas makes this clear from the beginning that this book is about correcting the flawed thinking that sabotages your execution and correcting it with some probabilistic methods. Chapter 2, The Lure and the Dangers of Trading. Chapter 2 explains why trading is so seductive and why it destroys most people. The attraction lies in the unlimited freedom that trading offers. There is no boss, no schedule, and no permission needed. You can trade from anywhere, make unlimited money, and answer to no one. For people who have felt constrained their entire lives, trading appears to be paradise. But here is the danger. That same freedom can destroy you. In normal life, society provides guardrails, rules, consequences, and boundaries that prevent you from doing severely damaging things. In trading, those guardrails do not exist. Douglas goes on to describe 4 psychological problems traders face. Problem 1, unwillingness to create rules. You came to trading to escape rules. Now you are being told that you need rigid, self-imposed structure. Most traders cannot accept this until after they have blown up their accounts. Problem 2, failure to take responsibility. Every loss is your decision. You cannot blame the market, market makers, or bad luck. Taking 100% responsibility is psychologically brutal, which is why most traders externalize blame and never improve. Problem 3, addiction to random rewards. Trading has the perfect structure to create gambling addiction, intermittent variable rewards. Even terrible strategies produce occasional big wins, which keeps you hooked and chasing that emotional high instead of following a process. Problem 4, trying to control the market. Successful people in other fields achieve success by controlling their environment, influencing people, managing situations, and making things happen through willpower. In trading, none of that works. The market does not care about your effort, intelligence, or how badly you need the money. You must learn to control yourself, not the market. Douglas is establishing a brutal reality. The very qualities that attracted you to trading and may have made you successful in life can destroy you in the markets. Chapter 3, taking responsibility. Chapter 3 explores more deeply why taking responsibility is non-negotiable for consistent profitability. Most traders intellectually understand that they are responsible for their results, but they do not psychologically accept it. They continue to blame external factors. The market trapped me, they hunted my stop, if only that news had not come out. Douglas argues that if you want consistency, you must begin with the premise that no matter what happens, you are completely responsible. You decide when trades begin and end. You choose your position size. You set or choose not to set stops. Every outcome reflects your decisions. Taking full responsibility means you cannot make excuses. Every loss exposes a flaw in your execution, discipline, or mindset. Your ego resists that level of accountability. When you externalize responsibility, you become a victim with no control. You cannot learn or improve because it is not your fault. When you internalize responsibility, you gain the power to change your results. The shift from "why did the market do this to me?" to "what did I do or fail to do that produced this result?" is where growth begins. Until you fully accept responsibility, you will continue repeating the same psychological mistakes and wondering why your equity curve resembles a roller coaster. Chapter 4, Consistency, a state of mind. Most traders think if I just find the right strategy, backtest it properly, and follow the rules, I'll be consistent. Wrong. Consistency has almost nothing to do with your strategy and everything to do with how you think about trading. Your beliefs about risk, uncertainty, and what it means to be right determine whether you can execute consistently. If you're afraid of being wrong, you'll hesitate. If you can't accept losses, you'll hold losers too long. If you need to feel in control, you'll overtrade or revenge trade. So what separates consistent traders from inconsistent ones? Consistent traders genuinely believe each trade is just one in a series of many, and losses are a cost of doing business, not personal failures. They don't need to know what happens next. They just need to execute their edge. Being right on any individual trade is irrelevant. Being wrong doesn't threaten their identity or confidence. Stop focusing on being right. Start focusing on executing your process perfectly, regardless of the outcome. That mental shift creates the consistency you're chasing. Chapter 5, The Dynamics of Perception. In this chapter, Douglas explains that your brain doesn't show you objective reality. It shows you a version of reality filtered through your beliefs and past experiences. For example, if you believe the market is manipulated and out to get you, you'll interpret normal price action as evidence of manipulation. You'll see conspiracy where there's just volatility. If you believe losses mean you're a failure, you'll avoid cutting losses because your brain is protecting your identity. Two traders can look at the exact same chart and see completely different things based on their beliefs. One sees opportunity, the other sees danger. Same data, different interpretation. Your beliefs create expectations. Expectations filter perception. Perception drives behavior. Behavior produces results. If your beliefs are distorted, your entire trading experience is distorted. Most traders don't realize their perception is filtered. They think they're seeing objective market reality when they're actually seeing a version shaped by fear, greed, and past trauma. Douglas argues that before you can trade effectively, you need to become aware of how your beliefs are distorting what you perceive. The market isn't the enemy. Your distorted perception is. Chapter 6, The Market's Perspective. What do I want to happen? How much can I make? What if I'm wrong? What if I miss this move? That's what most traders think about. The market doesn't care about you. It's not personal. It's just information. Buyers and sellers expressing their beliefs about value at any given moment. Price moves based on order flow, not your hopes. Most trading errors stem from imposing your desires onto the market instead of reading what the market is actually communicating. You need to make back your losses, so you take low probability revenge trades. You want your trade to work, so you ignore signals that it's failing. The solution is to adopt the market's perspective. Ask, what is the market telling me right now based on price action and structure? Not what do I need it to do? When you see the market on its own terms, you stop fighting reality. You stop taking price movements personally. You become responsive instead of reactive. This is what Douglas means by operating from the zone. a mental state where you're completely neutral, reading the market objectively and executing without emotional interference. Chapter 7, The Trader's Edge, Thinking in Probabilities. This is arguably the most important chapter in the book. It is where Douglas explains probabilistic thinking, the cornerstone of consistent trading. Each trade has an uncertain outcome, but a series of trades with positive expectancy produces consistent results. Think like a casino, not a gambler. The casino model is simple. They do not know whether they will win the next hand of blackjack, and they do not care. They know that over thousands of hands, their edge will play out and they will profit. They think in probabilities, not predictions. Most traders intellectually understand probabilities, but do not psychologically accept them. They still treat each trade as if it has to work. They still take losses personally. They still try to predict individual outcomes. Douglas introduces 5 fundamental truths. 1. Anything can happen. 2. You do not need to know what is going to happen next in order to make money. 3. There is a random distribution between wins and losses for any given edge. 4. An edge is nothing more than a higher probability of one thing happening over another. 5. Every moment in the market is unique. Accepting these truths is difficult. Your brain craves certainty and control. Embracing fundamental uncertainty feels uncomfortable. But that discomfort is exactly what you must accept to trade consistently. According to Douglas, here is what you should do. Enter trades without attachment to the outcome. Cut losing trades without emotional pain because you accepted the risk upfront. Let winners run because you are not trying to be right. You are simply executing your edge. Do not celebrate wins or mourn losses. Execute the next trade. When you truly think in probabilities, fear begins to disappear. Risk is no longer threatening. It becomes part of the statistical process. Make your trading mechanical at the execution level while maintaining mental flexibility to adapt to what the market offers. Be rigid in your rules and flexible in your expectations. This chapter alone is worth reading the entire book 10 times. I'd also like to add my own experience with probabilistic thinking. The most important aspect is that your edge must have a high return on investment. That's what makes you profitable long term. On every dollar you risk, you want to make at least $3, which is a 3 times return. The higher, the better. Take a look at my trades. In February, I had 5 losses and 9 wins. I made a profit of $41,140 and a loss of $3,388. My best trading days were on the 13th, 14th, and 6th of February. Those trades were 18x, 12x, and 15x return on investment. At Mookie Labs, we offer account management. We'll help you structure your risk and share trades with you to grow your capital with a profit split. If you're interested in this, send us a message. Chapter 8, Working with Your Beliefs. Douglas makes a critical distinction that your beliefs are not facts. They are mental frameworks you have adopted based on past experiences, and they can be changed. He outlines 4 steps. Step 1, identify limiting beliefs. What beliefs are driving your trading errors? Common examples include, I need to be right most of the time. Losses mean I am a failure. The market is unpredictable and dangerous. I need to know what happens next. Step 2, acknowledge that these beliefs are not serving you. Your current beliefs are producing your current results. If you are not consistently profitable, your beliefs may be part of the problem. Step 3, choose empowering beliefs. What do consistently successful traders believe? Each trade is just one in a series. Losses are feedback, not failure. I do not need to predict. I only need to execute my edge. The market is neutral. It is my perception that colors it. Step 4, install new beliefs through repetition and experience. You cannot simply decide to believe something new. You must repeatedly act on the new belief until your brain accepts it as true. Douglas emphasizes that changing beliefs is uncomfortable because it requires you to act in ways that initially feel wrong. You must trade through the discomfort until the new belief becomes your default operating system. This is not theory. It is practical mental reprogramming. Most traders never do this work, which is why they remain stuck in the same psychological patterns for years. Chapter 9, the nature of beliefs. Chapter 9 goes deeper into how beliefs form and why they are so powerful. Douglas explains that beliefs are energy structures in your mind. Once formed, they become automatic, operating below conscious awareness. They filter perception, generate expectations, and drive behavior without you realizing it. Beliefs form through experience. Every significant emotional experience, especially painful ones, creates or reinforces a belief. One bad loss where you did not use a stop can lead your brain to believe stops do not work, or the market is out to get me. Here is why beliefs are difficult to change. Your brain is wired to protect existing beliefs because they have kept you alive up to this point. Challenging a belief feels threatening to your identity. This is why traders resist changing their thinking, even when it is clearly not working. The belief behavior loop. 1. Belief creates expectation. 2. Expectation filters perception. 3. Perception drives behavior. 4. Behavior produces an outcome. 5. The outcome reinforces the belief. Here is how you break the loop. You must consciously interrupt the pattern. When you catch yourself acting on a limiting belief, stop. Acknowledge it. Choose a different action based on an empowering belief. Repeat this process until the new pattern becomes automatic. Douglas is showing you that your trading results are not random. They are a direct reflection of your belief structures. Change the beliefs, and you change the results. Chapter 10, the impact of beliefs on trading. Chapter 10 applies everything from Chapter 9 specifically to trading scenarios. Douglas breaks down how specific beliefs create specific trading errors. I need to be right. You hold losing trades hoping they will turn around because admitting you are wrong threatens your identity. Missing a move is painful. You chase trades that have already moved, entering at the worst possible price just to feel involved. I cannot handle another loss. You avoid valid setups because fear overrides your process. I need to make back yesterday's losses today. You overtrade or increase position size recklessly, compounding your losses. Douglas emphasizes that every repeated trading mistake can be traced back to a belief. If you keep making the same error despite knowing better, it is because an unconscious belief is driving the behavior. The solution is to track your trading errors for a week and look for patterns. Each pattern reveals a belief. Once you identify the belief, you can work to replace it with one that supports consistent execution. This is detective work on yourself. Most traders never do it because confronting your own psychological flaws is uncomfortable, but it is the only path to real, lasting improvement. Chapter 11, thinking like a trader. Chapter 11 is the culmination. Douglas brings everything together and gives you the framework to truly think like a trader. The goal of this chapter is to internalize the 5 fundamental truths so completely that they become your automatic way of thinking. When this happens, you enter the zone, a state of complete confidence, discipline, and detachment. The 5 fundamental truths again. 1. Anything can happen, except complete uncertainty. 2. You do not need to know what is going to happen next. Release the need to predict. 3. There is a random distribution between wins and losses, detached from individual outcomes. 4. An edge is simply a higher probability. Trust your process over time. 5. Every moment is unique. Stay present and flexible. How do you install these truths? Douglas provides a mental exercise. Before every trade, consciously remind yourself of these truths. Say them out loud if necessary. Over time, they become automatic. What thinking like a trader actually means. You execute your edge without hesitation. You cut losing trades immediately without emotional pain. You let winners run without fear of giving back profits. You do not celebrate wins or mourn losses. You move on to the next trade. You see the market objectively, not through the lens of fear or greed. You take 100% responsibility for every outcome. You think in probabilities, not predictions. The zone state. When you are in the zone, trading feels effortless. There is no internal conflict. You see setups clearly. You execute without hesitation. You manage risk naturally. You are completely present. This is not luck or a rare occurrence. It is the natural result of having the right mental framework. The successful trader you want to become is a future version of yourself that you have to grow into. It's not about learning new strategies. It's about fundamental identity change. If you have any book you'd like us to break down for you, leave a comment.